Got a really interesting video today. We've got Sam Roberts from Cartwright. And basically, Cartwright are a pension advisory service, and they've advised on one of the first UK pension schemes to allocate Bitcoin to their fund. So keep watching the video to the end. Like, share, and comment along the way. But let's do this. Hi, Sam. How are you doing today? Good to see you.
Very well, thank you. Thanks for having me on.
Thank you very much. And just to give a bit of an update about Sam Roberts. So obviously Sam works for Cartwright, and basically Cartwright, the pension specialist for defined benefit and hybrid schemes, recently announced a pioneer in Bitcoin allocations to the investment portfolio of a UK pension scheme, which is big news. Hence why I wanted to get you on, Sam. So Sam, can you just do a bit of introduction about yourself and just give us a bit of an update, and then we can maybe go through some questions if that's all right?
Yeah, sure. So, I mean, the firm itself advises pension schemes in the UK, as you say, as well as some other entities such as charities and companies. Myself, I've been in the industry for 25 years, and sort of the potted history is worked its way through, particularly following the global financial crisis, worked through Austrian economics and sort of being a gold bug before I found Bitcoin, didn't understand it initially, went away for a few years, came back again, and obviously found some time to dig into it in more detail. So exciting to see where we are now.
Fantastic. And how long have you been at Cartwright then, just if you don't mind me asking?
8.5 years.
Oh, wow. Fantastic. That's a nice long term that you've got there. Fantastic. And just to kind of sort of move on, I mean, I've got quite a few questions to get through, and it'll be interesting to kind of get feedback on that. So my first question really is, what prompted Cartwright to kind of explore Bitcoin as an asset class for pension funds?
So our role as an investment advisor is to give whole of market advice. So whatever's out there from an investment point of view, we want to be able to advise on it. And for also part of that, we always want to be looking for, well, what's new, what's innovative, what's interesting. Now, what triggered in my brain that Bitcoin should be moved onto the list of asset classes that are considered by institutions, pension trusts in particular, was back in February 2022. So you'll remember that was when Russia invaded Ukraine. Mm-hmm. And it wasn't so much that it was Russia or Ukraine, but it was more the reaction to that, which was the US, the UK, Japan, and the EU all confiscating, or actually technically at that point freezing Russia's assets in terms of the bonds from other governments from those four areas. So that then really brought home, that to me was an inflection point, because it brought home, and I thought would gradually bring home to lots of people, that government bonds had historically been seen as risk-free assets, and for good reason. But now they're not, at least not in the same way. Because if a government falls out with another government, then the precedent has been set that there is now counterparty risk on those assets. So that at the margin initially, that will then mean that governments move away from holding other government bonds as in their reserves. And so the question then is, what do they use instead? I'd expect them to use gold. Well, I think that's it. So I think then Bitcoin moves on to the list. It becomes more attractive because you're looking for something, what's out there that hasn't got counterparty risk. So you could use gold, and gold's obviously been around for 5,000 years. It's for most of that period, it's done a pretty good job. But the problem is moving gold from over long distances is a real pain in the neck, and it's costly. Whereas Bitcoin, we know, is virtually free if it's done in the right way. So there's a lot of advantages, as we know, of Bitcoin over gold, and they'd really come into play. And its trade will still happen between different countries, but they'll want to. This is really the importance of a good money. A good money is one that can be used by everyone in trade. So that even if you're trading with your enemy, you've received your gold or Bitcoin, and you know that you've then got it. That's yours, and you've traded it for whatever whatever goods and services. You're not then relying on sort of counterparty to pay up at a later stage. There's no credit involved. You've just got the money. So anyway, so I saw that as an inflection point that will gradually come through over the following couple of years or so, and here we are.
Fantastic. So how did you convince the trustees to consider Bitcoin? Obviously, traditionally seen as risky for long-term investments. So that must have been a bit of a struggle, or was it quite easy?
So, I mean, the first thing is that, so one of the key filters for any institutional investor is what's your time horizon. So if your time horizon is, let's say, 6 months, then, I mean, you shouldn't be buying Bitcoin, you shouldn't be buying equities. I mean, given the volatility in government bond markets, you probably shouldn't be buying long-dated government bonds. So there's lots of things you shouldn't bother with. But if you've got a long time horizon, which might be 4 or 5 years, or ideally the longer the better, then you can handle the volatility of an asset. So that's initial sort of
so time horizon was a critical thing to kind of
absolutely critical. And you've got 5,000 defined benefit pension schemes in the UK. Maybe half of them have got a fairly short time horizon, by which I mean up to 2, 3, 4 years. So because they're looking to hand over the entire scheme to an insurance company, so that's their time horizon. So they should just focus on that and get maximum security for those members in those defined benefit schemes. But the other half have got longer time horizons, and so then it becomes a serious option to consider more volatile assets. And you put that together with a small allocation to Bitcoin. So we're talking here about 3% for this particular scheme. So by definition, that means that 97% is invested in other stuff. It's invested in equities and bonds and property. And so you've got a very well diversified portfolio, and you've got a small allocation to Bitcoin within that. And then you look at the sort of risk and return of that overall portfolio, and the volatility of the overall portfolio is very similar to what it was without Bitcoin, but the expected return is materially higher because, well, okay, we're making certain assumptions about the future there, but the risk return trade-off looks very attractive.
And can I just circle back on the 3%? Where's the 3%? How did you value the 3%? I mean, obviously people are talking from 3 to 10%. I keep hearing the markets on a global level from a corporate perspective, not on pensions, in terms of people adding it to their balance sheets. Where did you get to the 3%, if you don't mind me asking?
Yeah, no, not at all. So it's trying to find that balance between having some exposure to getting off zero, some exposure, but being able to sleep at night. And
that makes sense.
Defined benefit.
If someone's new to this, then that's where you got to that. I understand. Okay.
Yeah, that's right. And so you want enough to say it's going to have a meaningful impact. If it succeeds, it's going to have a meaningful impact a positive impact on the scheme. But let's say, and we did specific analysis around this, let's say the day after they buy it, Bitcoin falls to zero. What's the impact on their long-term objectives? And the long-term objectives is to get to a position where they can hand the whole scheme over to an insurance company. And without Bitcoin, that's expected to take about 10 years. If we include the 3% of Bitcoin and it immediately falls to zero, you've lost 3% of your assets. That 10-year time horizon goes to 10 years, 3 months. It's obviously worse, but it's not dramatically worse. However, if Bitcoin succeeds in line with sort of the best estimate assumptions that we used, then that time horizon goes from 10 years to 8 years. So that highlights the asymmetry of the growth profile.
Interesting. Okay. That kind of highlights, I guess it's just risk appetite at the moment. Obviously that would be subject to change, I guess, if this was 2025 and you were doing this. I mean, we haven't got a time machine, but if you were doing this in 2025, would you allocate higher? This is a question completely off grid, but would you allocate higher? Would you promote that, or would you still stick to that 3% at the moment?
I think
Because
if
obviously
they only need, I mean, there's nothing magical about the 3%. That's what worked for this scheme, and we did some analysis around 2, 3, and 4% because that felt about the right level, and we could see then the sensitivity. For a completely different scheme, it depends on what they want to achieve. It depends on what their risk appetite is. So it might be that we go higher, it might be that we go lower. It just depends. I think the important thing is going back to that time horizon. So if the time horizon is long enough, then because of the risks, actually the risks associated with not holding Bitcoin, that means that they should be considering it, and then it's a separate decision about how much.
Sam, I love that. The risks of not owning Bitcoin. And if you asked me 5 years ago, would we having this conversation? We certainly wouldn't. It just shows you how far things have kind of moved on rapidly.
But shall I tell you why that is? So why is there a risk of not holding it? So it's to do with what I think you probably heard of before, which is sort of the black hole theory, which is that Bitcoin is sucking in. So we understand monetary premiums and stores of value. So in other words, things like property, so real estate, equities or bonds or cash or gold, definitely included with that. Part of the value, part of their price at the moment that we see in the market is related to them being used as a store of value of some sort. Not all of it, because obviously we'd still buy houses even if we just lived in them and they had no investment value whatsoever. But part of it is to do with, and so we'd label that the monetary premium. And no one really knows how big the monetary premium is in all those assets. You can do some sort of analysis and wave your finger in the air and have a bit of a guess. But it's probably quite substantial because we've all been, over the last 50 years in particular, been trying to protect our wealth by holding assets of different types, the ones I've named. So then, if Bitcoin succeeds as a pure monetary premium asset, then it should absorb monetary premium from other assets. That's why Bitcoin will rise in price, because it's absorbing that monetary premium out of other assets. So that means that all else being the same, the price of real estate and equities and gold, etc., will fall in value to their sort of industrial use value, or their utility value.
I thought my view, so it wouldn't go up in price against, because my perception is on this when I keep reading it, is all asset prices will go up.
Well, yeah. So let's separate two things there, right? So we've got, one is the pound, the dollar, the yen, the euro, and lots of other currencies, however many there are in the world these days, 120 or something. All those government currencies will almost certainly fall in value over, take your period, 5, 10 years, whatever. Will fall in value because they can be printed at will, created at will, and it's the easy option to take politically to ease the money supply. So you got that. So what the implications of that is that we'll get higher inflation, and indeed they're targeting 2% inflation. So that means they're going to have to increase the money supply by at least 2% a year to enable that. So we'd expect the price of all these assets we just talked about to go up. But that's not because the value of those assets is going up. It's because the value of the government currency is falling. And you've got a numerator, which is the asset, which is an ounce of gold, let's say, and you've got a denominator, which is pound sterling. And the gold, you've still got an ounce of gold in 10 years' time if you've got an ounce of gold now, but the value of the pound has gone down, and therefore the price denominated in pounds of gold, of that gold ounce, has gone up. So that's one effect that's going on. That's why a lot of asset prices rise over any particular period of time. The other aspect, which I was trying to draw out before, was it's the relative value between each of those assets. So it's that, ignoring the general price level, you'd expect the relative value of Bitcoin to rise against these others because it is a better store of value, a better monetary premium asset than real estate, gold, etc. And so what do pension schemes hold? What do a lot of institutional investors hold? They hold gold, equities, bonds, property, which are all at risk of falling in relative value if Bitcoin succeeds. And so Bitcoin then becomes the hedge against Bitcoin succeeding as that pure monetary asset.
I love that. That's amazing. Wow. And I guess this was a part of your pitch when you went to this particular pension fund to explain the kind of, it's almost going through the history of money with asset allocation, discussing assets and how assets are changing, right? Because I mean, you go back even 5 years ago, it's almost, you couldn't fathom of having this conversation with a pension fund to go, look, actually, I really think Bitcoin's good. And that's why when I saw your show, you did a podcast a while ago, and I thought, I've got to get you on because this is like, it's such big news to have that kind of movement. But just tell me, why was this move really significant for the UK pension industry? I mean, is this now the start of the domino effect?
Well, I think it is. Well, so it's important. It's important because it's the first one, and we've got to start somewhere. But I think it's also important because the pensions industry is going through a difficult time because you've got some quite big changes going on I'm talking about the UK in particular here. You've got the gradual decline of the defined benefit pension schemes, and you've got the rise of defined contribution, and they've each got their flaws, and then you've got some options in between which are starting to come through. But the problem is that for a lot of people, they don't understand the defined benefit, they don't understand the defined contribution, all these other options, and we need to simplify it down. And so for most people, they shouldn't really be investing in the sort of true sense of the word, which is, and investing I'm defining there as basically you're taking on counterparty risk to support a business in some way. It could be lending the money, it could be taking equity, or property portfolio, whatever it might be. That's investing in my mind. And there's what a lot of people should be doing mainly is just saving, but they haven't had a great option to save because of the value of the pound falling over time. And there's some great charts out there showing how the value of, if you just hold pounds, pound sterling, then they fall in value over time. So it's not a great option. And because of that price inflation for the pound, we've seen people consume more than they probably should be, or buy stuff they don't need. That's a waste of resources. It's not helpful. It doesn't lead to longer term standards of living increasing.
Sorry, that's really interesting. Why is that though? Why would they be buying more? Because they're getting stressed or what?
Well, you've got sort of three. Well, maybe, and that might be part of it, psychological, to make us feel better. But you sort of got three things you can do with your money. You can either spend it, you can save it, or you can invest it. And if the option for saving has not been good, hasn't really been a choice. Okay, some people have used gold, but the problem then is when that then squeezes the savings bucket, so that people feel that either they think, well, I'm going to lose some value of this money anyway over the next few years. I might as well spend it now. I might as well go on that holiday. I might as well. And some of that they may have done anyway, because, we'll like a holiday. But generally speaking, it's been buying stuff they don't really need. On the other hand, you say, well, okay, to protect the value of my money, I need to invest it. But the problem is, even something as we're used to, like bonds or government bonds, they're actually very complicated. And to really understand it, you need to do quite a lot of study. And so people in general are investing in things they don't really understand. So you've got, because of inflation, people are buying stuff they don't need or investing in stuff they don't understand. That's not a healthy situation. No. And it also encourages a lot of misallocation of capital. And there's a lot of talk about lower productivity in the UK. Well, this is going to be a massive part of it. People are doing things they don't really want to be doing, but they are. So this is, so you end up with that situation.
I think that's interesting because what I think as well, like we're traversing now. I mean, I've got two nephews, one of which is very, very pro crypto, and he's 19 now. Now, this new generation, when I was 19 in the workplace, I was just told, put your money into this pension. That age group when I was younger, I'm 46 now, giving my age away. But that's what you were told to do for years and years and years. Forget about it, put your money into that. Now this new generation, usher in this new generation, it's interesting because now their perception is, look, I don't want anything to do with that, what they class as TradFi. Right? I don't want anything to do with that. I just need to go into this new crypto thing. I know about Bitcoin, and it's always Bitcoin, plus they've got their altcoin risky sort of bits. That's fine. But my view is this has come at a good time because people are going to start wanting this, especially the younger generations, right? We're going through generational impacts now. The younger generation are going to be growing up, and this is happening, I think, at the right time. So just a quick one. So what specific due diligence measures were taken, though, Sam, to ensure Bitcoin's viability in this portfolio that you chose?
I mean, a lot. And in some ways, in some ways it was more than we would do on any other asset class. And that's probably wrong, but that's what happened, because you have to be extra cautious because it is a new asset class. And people want to. So if you said, do you want to buy an equity fund, then it'd be pretty straightforward and so on. But if you want to buy Bitcoin, okay, you're going to really deep dive on it. And of course, being the first one, we wanted to make sure we left no stone unturned. So there's quite a few things. So we've touched on two of them already. So one is the allocation size and making sure that's right. I mean, that is part of the due diligence, and making sure the scheme is in the right position. So having a long time horizon. But we also, a few other important things was making sure the trustees went in with open eyes about what could happen. So in other words,
what could go wrong?
Well, yes, but also I suppose that comes down to the price, because we want it to only come down to the price. So the only risk that they should be taking is the risk of price volatility. So to rule out any other risk, it really comes down to the only other key risk is the custody of Bitcoin. Well, I suppose also we're focusing on Bitcoin, whereas the risks associated, we haven't talked about it yet, but obviously Bitcoin is very different to sort of crypto. And so in sort of straightforward terms, so Bitcoin money and everything else is, it's either a tech company or actually there's quite a few scams out there. And
agreed.
It takes people need to go in with open eyes as to what they're getting into, whichever way they're going. But for our clients, we're only comfortable advising on Bitcoin, given it's that form of money, and given the expected returns and the volatility, they don't need more than that either.
No, but I guess, Sam, the spot ETF and I guess government wake ups, if you like, around the world, especially with the US, all these kind of geopolitical things happening, that must have helped your case, right? Well, especially the spot ETF.
Yeah, well, a lot of that has come about, I mean, over the last few months, when, we invested in October, but the decisions to invest were made a couple of months before that. And so we were, I mean, you're right. If you look harder, then these geopolitical tensions have been going on for years, decades, really. It's just that Bitcoin has only existed for the last 16 years, and even then, for the first 15 years, I don't think it was institutionally appropriate. And that custody element was absolutely critical. So we want to hold it in the most secure way possible. As I say, so the only risk that we're taking is the price volatility. And so we've got an arrangement which allows, I mean, we're not holding a private key.
Sorry, I missed that. You are holding the private keys.
We're not holding a private key.
Right. So what is it, like a multi-sig storage strategy?
It's exactly that. So it's cold storage. They're holding. We've got the Bitcoin address for the trustees, so their own Bitcoin address, and they're two or three multi-sig. Each of the private keys is held by a specialist company in this space. And it needs two or three of them to sign. So you've got so much, and they've each got their policies and procedures around how they hold their own key. You've got that trying to remove as much single points of failure as possible.
This is going to be big, I think, for any company going forward. It's all about that, isn't it? I think, like when I opened up the call with you offline, that's the perception, even for the S&B market, is the barrier to the entrance to market with Bitcoin holdings. It's too much stress, and then instantly just turn off. And it's like, I better not, But once you've got this kind of strategy in place, it's mapped out, and you've discussed these more secure holdings, if you like, in vaults with multi-sig, then it starts to change the perception. I guess you had that once you walk them through that.
Well, it makes it feel a lot more like a normal investment in something else.
Yeah.
And can you imagine the situation if you had a group of trustees all with a cold card or something like that, hardware devices? It's not going to work, is it? It's not practical.
No.
So we worked with.
You said it right. It's like comparing it to a real investment, then, isn't it? It's like even having a bank account, right? You could have certain members of staff in finance and directors that have access to the bank account, the main bank account, anyway. So just a quick one. So this has been bugging me as well. But I've got quite a few questions to get through, but this one has been really intriguing me. So how does Bitcoin's asymmetric return profile complement traditional pension investments?
I mean, very well is the short answer. And it comes to, I suppose it comes down to really the basics of having a diversified portfolio. So you want assets which have got good potential, but move differently to the other assets in the portfolio. And Bitcoin achieves both of those because it has, the correlation with other assets changed over time, but on average, it's close to zero correlation with any other. So in other words, it doesn't move in line with other types of assets. So the other asset might do very well. Maybe Bitcoin is flat or goes down, and the reverse happens.
And can I ask, sorry, just that pitch that you did, was it very hard to get it over the line, or was this like months and months, or was it a year's work? What was it?
It took about a year from raising it to investing. And I think if we did it again, when we do it again the next time, I think it'd be quicker because some of that was making sure all this due diligence is in place and we've got a smooth path. There's a lot of paperwork involved to get these things signed off and implemented, but we've now done it. So the next time will be faster.
Yeah, you've done the hard work.
I guess one thing that might hold it back, and it should hold it back if the trustee's not ready, is the education piece. So people shouldn't be jumping into this thinking, "Oh, this is interesting. The price has gone up. Let's buy some." That's the wrong reason. So this is and the trustees have got lucky over the past few weeks, with the bump in the price because of the Trump election. That was never part of the plan. That was never part of the reasoning for buying. It was saying, look, we've got 10 years. This can help us on that journey. There's no short-term gains in this.
I guess Michael Saylor must have been a great advocate to sort of share videos with those people as well. Talking about trustees, so what role does trustee education play in adopting unconventional assets like Bitcoin?
It's the whole thing about you shouldn't invest in something you don't understand.
Right.
And the irony sometimes is that often people do. Do trustees always understand what they're investing into? So it's the same sort of thing, really. We went the extra mile with Bitcoin to make sure that they went in with open eyes. Was
it a hard sell?
No, it was. There were some raised eyebrows initially when I first raised it, but we also talked about that there are risks here, right, which need to be understood, and we can mitigate a lot of them. Like the custody arrangements is a great example. We can mitigate a lot of those risks, but it's understanding what they are, understanding what you're left with, and then understanding what those remaining risks could do positively and negatively within your overall portfolio and with your overall long-term objectives. And then for the right schemes, that then all starts to fall into place.
Yeah, that makes total sense. I guess it's just education. It's education. I think, and then once you
Yeah.
start to see more, I mean, what I've even noticed now, you go back a few months ago, it wasn't even talked about in mainstream media now. Now it's starting to wake up, and it always goes up, price goes up, mainstream media come in, especially in a bull run. Yeah, that's interesting. And like you say, it's education, getting the people on board and just showing really the risk reward factor, I guess, what they're against. And as you said,
it's approaching it like any other asset. I think
mm,
that's the bit that's sometimes missed. If let's say it wasn't called Bitcoin, it was called something else, and we went to trustees and said, "Oh, we've found this asset. Done lots of research. We found this asset which could, has these various different investment attributes. We're saying don't put much in, just put 3% in. Add to your portfolio. Here's the impact on your portfolio. Here's the positive impact on your potential positive impact on your long-term objectives." Most people would say, "Oh, that's interesting. Tell me more." Whereas if you mention Bitcoin too early in the conversation, it's like, "Oh, no, we don't want anything to do with that." So there's a big gap in that education piece at the moment, which we're trying to help to fill, partly through these podcasts. So thank you.
Yeah, no, welcome to the show. It's great to have you on. So how does Cartwright manage Bitcoin's volatility to protect scheme members' interests? Because that must be quite a big thing for you.
Yeah, so it's again some of the same things: small allocation, long time horizon, but also things like we'll put a rebalancing mechanism around the allocation. So if you, pick your assumption about what Bitcoin could potentially do in the future. If you then leave that allocation long enough without touching it, you're going to end up with a very high percentage to Bitcoin in that portfolio. That's not going to help people sleep at night. First of all, if you've got a 50% allocation to Bitcoin, it's not going to help them sleep at night. There's certain regulatory issues, which means you probably shouldn't be holding that much, and also they don't need that much to achieve their objectives. There's a sort of a limit to how much return they actually need to achieve their objectives. So instead, what we can do is we can set, and it's very flexible how we can do this, is we can say, right, let's say, I'll just give some example numbers to keep it simple. But let's say you start off with 3%. What we can say, well, when it gets to 6%, then we'll trim a bit. And there's nothing magical about the 6%. It could be 10%.
Right.
But you trim a little bit down. And then whenever it hits that 6%, you trim a little bit more. So you'll
to reinvest in other asset classes in a fund?
Exactly, yeah.
Right,
yeah.
interesting.
So that extra, whatever that pound amount is that comes out, that will then go into the rest of their portfolio to invest in bonds or property or equities.
But can I just ask, would you define that as DCA, so dollar cost averaging out? Is that the kind of percent? So I get my head around it.
Not quite. I mean, well, sort of, but not quite, because it's based on when Bitcoin performs well, then we sell a bit, rather than we'll sell a bit regardless of the price.
Right, got you. Okay. And then that's protecting you, because essentially you're making some money out of the new 3% allocation, putting that back into something else, making use of something that you haven't already got. That makes sense. Something you've just got into this new asset class. You've made hopefully substantial amounts of funds within Bitcoin, and you reallocate a percentage of that when you've done well into another asset class.
Exactly. And I think
I find that interesting. I don't know how that's how you would do it. That's okay. And that gives them more
comforting to then invest. They invest a certain number of millions of pounds, and then through this trimming profits process, well, once they've got their original investment out, it's like then the rest is. I mean, I don't want them to think about it like this, but it's a little bit like the rest is you're playing with the house's money.
Yeah. They got their ROI back, and now they can go, actually, now I can focus on other things as well and reinvest.
And I think there's definitely something psychologically beneficial about getting the original investment back, and then you still want to be trimming that allocation. You still want to be managing that, because it's real money. You want to be managing it carefully, but I don't know. It's just with it being new and volatile, it can give a lot of comfort.
Yeah. Sam, explain to me the low investment threshold mentioned in your strategy, and why is it crucial at the business?
it comes back to that. If you, let's say, it went to zero overnight, what's the impact on your long-term objectives? And of course, the bigger the percentage, the more impact it's going to have. And that's why it's going to depend for each separate pension trust or charity or corporate treasury. The percentage has got to be right for them, and there's no one answer.
And have you got a lot of meetings booked up with other pension funds? Is that on the horizon? Is that your work now to kind of push that?
Yeah, that's part of my work.
This is a good case study to move forward, you know?
Yeah, exactly. So we've got, I mean, the pension trust world is, relatively slow moving, in the sense you've got, maybe got 2, 3, 4 meetings a year that each pension trust will have. And so it takes time for ideas to percolate through. There's been a huge amount of press coverage over the past few weeks. Obviously, we've now got Christmas, so hopefully all pension trustees across the industry will read the Bitcoin standard, or there's a great one that I've seen recently, which I've been starting to tell people about, which is the myfirstbitcoin.io. It's their Bitcoin diploma. I don't know if you've seen that.
I haven't. No. Can you explain a bit more on that?
This is a hard.
Who's behind it?
This is a hard copy. So if you go to myfirstbitcoin.io, scroll down a bit, and then there's a link to the Bitcoin diploma, which is, I say, it's a PDF of this, and it talks through what is money and what is Bitcoin and various other things and how it works and how to use it. And it's free to download, and it does, I think, a good job. I mean, it's aimed at kids.
Sorry, who's behind that?
Well, so I think that's come out of, there's something called, I'll probably get this pronunciation wrong, but Prima Bitcoin, I think which comes out of El Salvador. So as part of my understanding of this is a bit sketchy, but as part of putting Bitcoin in place as legal tender, they also started up some educational classes, particularly for schools.
I heard about this. It's from that, is it?
It's around that. And then I think it was maybe last year that they translated it into English, and this is the version. So if someone speaks Spanish, there is also a Spanish version to download, and maybe some.
We'll put the link up on the screen when we re-edit this. So what lessons from Bitcoin adoption can other pensions funds learn from you on this, basically?
I think it's just to have sort of open eyes on the options available, and we're not saying that every pension scheme or charity or corporate trust should buy Bitcoin. We're not saying that. What we're saying is that there's a whole range of different asset classes which you could invest in, and Bitcoin should be on the list. And then just like they do with all the other asset classes, you work through them and say, okay, we like that, we don't like that, this works for us, that doesn't work for us. And maybe Bitcoin makes it through that filtering process, or maybe it doesn't. But as I say, it should be on the long list. And it sort of goes back to actually quite basic investment portfolio management theory, which is you want a lot of different assets that do different things. And yeah, it doesn't mean you buy all of them, but if you've got a mixture, then you can get a better risk-adjusted return. You can get a better trade-off between risk and expected return, and that's what anyone who's got a fiduciary responsibility for other people's money, which is what we're talking about when we're talking about institutions, that's what they should be doing from an investment point of view. So, I mean, it's just treating it like every other asset. That's all we're saying. Yeah.
And looking ahead, do you foresee Bitcoin becoming more of a standard pension asset like equities or bonds for the future?
Yeah. I mean, definitely. I mean, it could take a few years, right? It takes a few years for these things to evolve.
It's still early time-wise,
But yes, I mean, if you look back to the 1970s, the first pension scheme that decided to invest in equities, everyone else must have looked around with raised eyebrows and think, what on earth are they doing? Why are they investing in that volatile asset? And then you've got high yield bonds in the 80s. You know, why? What they literally call junk bonds. Why are you buying junk bonds? Or liability-driven investment in the sort of 2010s there were a lot of raised eyebrows there, but actually they are now prevalent across the industry. So each of those equities, high yield bonds, and LDI need to be treated. They've got risks, they've got pros and cons, they've got advantages, disadvantages. They need to be considered, but they need to be considered in the round with everything else that's invested in that portfolio. And it comes back to Bitcoin should be on the list. That's all we're saying.
Right. And obviously moving into 2025, obviously ESG considerations have often been cited as a barrier to including Bitcoin in portfolios, particularly around environmental concerns. So question is, how is the narrative shifting, and what should trustees consider when evaluating Bitcoin through ESG lens?
Well, I think the first point to make is that the narrative is shifting. So why? And so it's shifting from Bitcoin is terrible for the environment to actually some of these reasons are a bit counterintuitive, but actually it's beneficial. So why is it taking time? Well, everything takes time. And in this particular case, it takes time for people to investigate, to study the effects, to study the ways in which Bitcoin, and we're talking Bitcoin mining in particular here, and how that is applied in different industries, and then to publish their studies, get them peer reviewed, etc. But we're now getting quite a few, and Daniel Batten, highly recommend reading anything from him. He's a climate tech, I think is the phrase he uses, investor, which is vague, and he's been an environmental campaigner for I think his whole life. He goes into a lot of this, and so he's worth following on LinkedIn. But that whole narrative is changing. It is, whether we're looking at reducing methane emissions, and there's various different ways in which that is done, landfill and gas flares and biogas, whether it's to do with supporting, because Bitcoin mining, you can turn it on and off at the flick of a switch without losing. Well, the only thing you're losing is not mining, not using those computers when they're switched off. But apart from that, you don't lose anything. And that allows electrical grids to be balanced because you've got flexible demand, and it allows the supply to be less flexible. So sort of the flexibility, you're moving it from the supply side with fossil fuels to the demand side with Bitcoin mining. And there's no other industry which can have that type of flexibility as quickly. AI takes a little bit of time to sort of save everything it's just been doing. So it's helpful, but not as flexible. So you've got, and I mean, I've only scratched the surface there. And that's before we get into the social benefit. It's a huge topic.
I was going to say social benefits. You add that into the mix, it's huge, right? For a company to start reviewing things, and you kind of go down a rabbit hole. There's a big plethora of information there.
Yeah, I mean, we've got separate training sessions on that. But I think one of the issues that we need to be sort of teasing out is using more energy is a good thing, particularly when it comes to the social benefits of that. Using more energy across society allows the standard of living to go up. But we need to separate that from dirty energy, or that is polluting the environment, that is polluting the rivers, the air, the countryside. So we need to separate those two out. And actually, Bitcoin mining is one of those things which, because it encourages more sustainable ways of producing energy, then it can benefit. You can still get more energy with less emissions. So there's, I mean, that's a whole big topic on its own, as I say. But that allows then the standards of electricity prices in the UK are incredibly high relative to other countries. We would all be better off if electricity prices were lower. There are solutions.
So was that a big question when you did the presentation? Obviously ESG is a big thing. What was the questions being asked by the pension funds? I don't know if you can reveal this or not, so tell me to be quiet if not, but was it a big thing about the environmental impact to say, look, we don't know if we're ready for this at the moment with Bitcoin? And did you have to educate them really deeply about what, for example, El Salvador is doing with hydroelectric to generate the nodes, if you like, for the Bitcoin network? Was it kind of these things you had to kind of bring to the forefront?
Yes. So, I mean, I think there were 3 key barriers to Bitcoin becoming an institutional investment. So the first one is no one wanted to be the first. So that's done now. So that barrier is down.
Right.
The second one is how can it be held securely? So the whole custody arrangements. Before this year, that didn't really exist, but now it does. So that barrier is solved. And the third one is the ESG, environmental social benefits in particular, benefits, pros and cons. And the narrative is changing on that. So you're right, there are still a lot of people generally, but also pension trustees who are nervous about, well, isn't it bad for the environment? So we're trying to talk to as many people and say, actually, you're not basing this on the actual facts on the ground. The actual facts on the ground are not only that it's not bad, but actually that it's good. And so trying to get the message across. So that's a work in progress, but I think that will help a lot of people out in 2025. Yeah.
Amazing. That's great feedback. It really is. It's so interesting. So finally, what are Cartwright's Bitcoin moves in 2025? And secondly, do you see more pension schemes adding to Bitcoin to their portfolios, which we kind of touched on really?
Yeah, I mean, yes, I do see more.
It's a big yes, isn't it? It's a big yes.
I mean, this is the thing. Once you get over the initial barriers, once the trustees get over the initial barriers and get into, okay, what does this mean in practice for my scheme?
Yeah,
pretty much, assuming that the long time horizon, etc., it's pretty much a no-brainer.
Yeah.
But it's just getting over that initial. Those initial concerns, or realizing those initial concerns are misplaced. And there is an advantage, as there is for any new technology, in being a first mover. And the same applies here. Your money is a type of technology that we use every day. If you're using a better money first, then it's to your longer term advantage. So we'll see that, and that's particularly enhanced because of the fixed supply of Bitcoin, the 21 million. That makes that first mover advantage even more stark. So yeah, we expect more pension schemes to invest in 2025. There'll be different ways that they go about that. There'll be different allocations, but I think the key message that I want to leave people with is, don't ignore this. Just treat it exactly like you would any other asset class. It should be on the long list, and then we can, and then it may not be right for you, in which case you've at least actively made a decision about it.
I think that's the most important thing is analyzing what asset classes are out there, and is Bitcoin going to be a part of the portfolio? Sam, so you're going to be, from my perception now, is you're going to be like you're going to be the Michael Saylor of the pension world.
That's far too much of a compliment.
Just not investing as much money. If you saw the latest round of what it's just insane, isn't it? Yeah, absolutely insane. Sam, look, really, really, really appreciate you coming on. We took a bit of time to, obviously, I know you've been hyper busy, so I really, really am thankful, most importantly, for your time today. Discussing how things are happening within your business and how you've convinced the first pension fund in the UK to kind of go on to the Bitcoin move. And obviously, it looks like this is going to be the start of something special. We still are very early. I always say this to people on my show, that we're early still. As much as Bitcoin has just hit the $100,000 mark, and we've got President-elect Trump coming in January, things are looking very, very bright. And I think this is going to be a great testament with you working with those pension funds in the UK. So, Sam, just a quick one. Obviously, thanks. But how can people find you, by the way? Are there any special links you want people to go to, like LinkedIn or anywhere else?
I suppose a couple of key places. So one is our website, cartwright.co.uk, cartwright.co.uk, and you can find me on LinkedIn.
Fantastic. Sam, many thanks for joining us. Much appreciated.